Hey everyone, I had an interesting recommendation from one of my subscribers asking to compare three gaming stocks and answer which one is the best one to buy. So that's what I'm going to do in this video. I'm going to compare Penn Entertainment versus Caesars Entertainment versus DraftKings and answer which one of those three is the best stock to buy. Remember, you can give me recommendations and requests as well to tell me which videos you would like to see me do. I would enjoy that very much. So go ahead and leave it in the comments down below. I take a look at them every day. So thank you so much for watching and making those requests. Let's get right into this video here, starting with revenue comparison. Looking at that metric, you can see Caesars absolutely exploding in revenue, going up to 10.8 billion, mostly due to acquisitions, although some organic growth in there as well. Next comes Penn Entertainment with 6.4 billion in revenue, and the newest startup DraftKings in the gaming business with 2.24 billion in revenue. Now, there's something interesting about each one of these stocks. So Caesars, as you know, has a notable presence in Las Vegas, whereas Penn Entertainment has casinos, brick and mortar casinos, but mostly around the country, not in Las Vegas. So spread out throughout the country. And I like that because right now, the area where Las Vegas is struggling with is business travelers. And I don't know if that convention business will ever recover to where it was before the pandemic. That's one area of industry that hasn't recovered and may not recover. Although the pent up demand from people trying to travel and get out of their house and have some away from home entertainment, that has remained strong for Caesars and Penn Entertainment, but Penn takes advantage of the fact that it's not suffering from the fall off in business travelers. Meanwhile, DraftKings is exclusively online. It has the fantasy sports betting, it has iGaming, and it has the mobile sportsbook. So that gives it an advantage longer term if it can continue to grow and scale, because it won't have the operating expenses that the brick and mortar casinos have. So I mentioned earlier, DraftKings is newer to the field and they're still growing, and so their profit margins, their cash flows are not as good as Caesars and Penn, who are very similar at 12.4 and 12.3%. Meanwhile, DraftKings is at negative 18.14% in terms of cash flow from operations to sales over the trailing 12 months, but DraftKings is making excellent improvement in this regard. Also, keep in mind, at scale, if DraftKings was to reach the level of revenue that Penn and Caesars have reached, I would assume, and it would be reasonable to assume, that its cash flow from operations to sales would be much higher. Because of the reason I mentioned earlier, it doesn't need to pay for the maintenance and operations of a brick and mortar casinos. Operating exclusively online provides a greater profit potential. But that's the key, potential. It has not yet reached that scale, and it's no certainty that it will ever reach that scale. And it's a similar story for their operating profit margins. Caesars in the lead with 22.23%, very solid profit margins. Penn Entertainment with operating profit margins of 15.35%. The house always wins, right? And so you can see it in these profit margins. I don't suspect that they will go much lower unless visitation decreases significantly, and then you get a big fall off in profitability because you still have to pay for those big operating costs to maintain those buildings when your business falls. That's the benefit that DraftKings can have in the long run, although right now it's still at negative 53.45%. But DraftKings will arguably not suffer that kind of cyclicality when there's a recession and revenue falls, because when revenue falls, DraftKings operating expenses won't be as high as the others in the brick and mortar industry, right? Because it doesn't have to pay for all that maintenance and staff and everything that you still got to pay for, even if you've got fewer customers. Maybe you can reduce staff to some degree, but you still got to maintain operations. You still got to have staff, maintenance, and all of that. DraftKings, not necessarily. So Therein lies the benefit, the potential for DraftKings stock. Well, I will note that Caesars and Penn also has an online gaming division. They are trying to ramp that up as well, but the majority of their revenue and profits come from the brick and mortar business. Finally, let's look at valuation. And judging by this metric, we see DraftKings trading at a forward price to sales of 3.158, the most expensive out of these three. Caesar's trading at 0.9 forward price to sales, while Penn is at 0.56. So if I had to pick one of these three gaming stocks to buy today, I would pick Penn Entertainment stock. That would be my pick to buy today. All right, but that's all I've got for this video. Once again, thank you so much for the request, and thank you so much for watching. I hope I'll see you again soon. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.